Hello, my name is Garrett Taylor, President and CEO of Advisors Successions. We're a firm that specializes in helping financial advisors buy and sell practices across the country. Today what we're going to be discussing are the tips to buying a financial advisory practice. First thing we want to think about as we dive into this topic is, what does it take to be a successful buyer? What are the criteria that we see across the country day in and day out that separate those that are able to buy practices from those that who are not? What are our views and keys to success? What are some of the landscape of the marketplace and the financial advisor population? Some of the roadblocks to the transition, and many other aspects when it comes to acquiring a practice. So first, let's talk about the realities of the marketplace. In the current environment, the ratio of buyers to sellers of financial advisory practices is 50 to 1. And in some cases, that number might even be higher. And we think this is a very overwhelming number because you as a financial advisor can have a great value proposition, a great structure, a great firm, but are really struggling to get out in front of those opportunities and those sellers that are out there, people who are looking to sell their business. What's great about this number also, though, is that it really creates some competition from a seller's perspective. And sometimes they just get very picky. So we want to really set you up as a buyer in a way that's going to differentiate you from the herd. What we like about the advisor population is that the average financial advisor currently is 55 years or older. And as a matter of fact, 25% of financial advisors are over the age of 60. And in the next 10 years, we'll see the average financial advisor age drive much higher into the 60s, with over 70% of financial advisors being over the age of 63. So if you can position yourself today as a qualified, strong buyer, which we're able to help you do in our process, you're really positioning yourself for great success moving forward and some real quantum growth within your practice. And we'll talk about some of those opportunities here moving forward. So first, what does it take to go out and successfully find a practice for sale, and what are some of the ways to do this? What are some of the things that you should be thinking about in the investment of buying a firm, and what are some of the challenges that are out there? And you know what? Even the biggest and most successful financial advisory firms struggle in identifying opportunities. So there's really a challenge for advisors who are actively looking to grow and who are capitalized in a way to grow to find those opportunities. Our firm has created a geographical exclusivity program which will really help you to eliminate some of these odds. What we've been able to do is to identify qualified buyers across the country to put them in front of the line and basically really build a marketing strategy around them. We'll use and utilize our financial professionals that we've built networks with across the country, as well as our telemarketing team and webinar effects and efforts, and really put you in front of qualified sellers and opportunities. And in doing so, what we're doing is we're increasing the likelihood of you having a success. Also along in that process, what we're able to do is help to source the opportunities, help to negotiate the deals, as well as create the paperwork and draft the documents necessary for you to be successful. So really what we found is that the most successful advisors who are acquiring practices on a regular basis are utilizing other resources and third-party vendors to go out and find those opportunities for them as well. So first step is, how do I set myself up as a buyer to be someone that's attractive to buy that particular practice and find someone who's really looking for a succession plan, and why me? So if your competition is 50 to 1, what's separating me from the rest of the financial advisors out there who are looking to buy these practices? And the first thing we want to look at is compatibility. Compatibility is the number one reason every single time in, time out, that a seller will sell their practice to a buyer. They want to know that you are the right fit for their clients. Many of these clients have become friends, some are family, and they really want to make sure that you as the buyer are taking great care of them. Some of the other things you want to think about in buying a practice are, which we'll talk more in detail about, is what is your flexibility? Are you willing to bend on some of the opportunities within that practice to get the deal done? What are the terms? How much for a down payment? We'll talk about persistence versus annoyance, and then ultimately what the deal flow will look like. So the first thing in being a successful buyer, we feel, outside of being a compatible advisor, is the flexibility. So geographic and practice flexibility will really help to open up your architecture and your avenue for more opportunities and ability to see more and more deals. So some of the things you want to think about are considering really expanding your target territory, and if at all possible, targeting both fee-based and commission-based practices. We have buyers come in time and time again that are only looking for fee-based practices that generate X amount of revenue. And what we found is that many of the successful buyers out there are really looking at practices in a different way. Instead of paying those high multiples for the fee-based practices, they're looking at finding some of the commission-based practices that might even be seen as distressed type assets, and then really creating their client service model around that business to drive revenue and ultimately drive value for themselves as a buyer and have to pay less money when acquiring those businesses. Some of the things that you might want to think about are considering transitioning the seller into your practice and providing a soft landing. So not always is a advisor who's looking to retire ready to hang his hat up or her hat up in the next 0 to 6 months. Some might be looking for that 2 to 3 year transition period. And in our opinion, if you're able to provide a soft landing for them, in that scenario, you're able to really solidify some of the client relationships. And the way that this deal is usually done is positioned as a merger. So when we position this as a merger, the clients are feeling confident that not only is the advisor still going to be around, they'll be getting an enhanced relationship. Whether it be with your staff or you personally, you'll really be solidifying those relationships for you to ultimately be that buyer and that person that will be acquiring that practice in that 2 to 3 year time frame. Another thing to think about is open-mindedness. I mean, if you find a practice that's a great deal, would you consider transitioning your own practice into a new broker-dealer? Many times we come across sellers that are not willing to leave their particular firm, and is that deal sweet enough for you as a buyer to really think about that transition? We don't favor one broker-dealer or the other. What we really look at is what makes most sense to get a deal done and what are the ways to make this effective and possible. So you as a buyer having that open-mindedness will really help to figure out what makes the most sense in any given deal. And having seen it done both ways, there's no one way or the other that's more successful. It's really just, again, the relationship that the seller has with his or her clients and that you as the buyer have with your own. And whoever has the strongest relationship or the biggest practice that's solidified, that's where you would then decide which broker-dealer to choose. The next is proposed terms. So contrary to popular belief, price is not the number one reason why someone will sell a practice to another advisor. As I mentioned, it's the right fit. However, price is a high priority. So what you want to think about is when you're making an offer to a particular seller, you want to make sure that that offer is at least at the market or better so that you're taken serious. And if you're really interested in this practice, you might want to consider paying above market or tweaking the terms to make it more favorable to put you out in front of the other potential offers that are out there. So one of the things that we look at as a buyer is that when you're buying a practice, your main risk is the down payment. After that down payment, if done correctly, the seller's revenue will be paying back the note on its own. So really you're paying back the practice with its own money. So this will allow you to be a little bit more flexible and a little bit more aggressive in positioning your particular offer. So that's something to think about as well. It's okay to tweak and propose different terms throughout the course of a negotiation process. That's where a third-party advisor really is helpful to help to tweak deals, negotiate deals, and make sure they smooth out all the rough edges. Traditional deals you'll see will be somewhere in the neighborhood of 20 to 30% down, and then the seller will hold financing for the rest of that note, usually in a period of 3 to 7 years, that will carry an interest rate of 5 to 5.5%. Now, more increasingly, as banks have started to lend a little bit more in the last few years, we've seen organizations out there that specialize in lending for financial advisors. So that said, a specific company out there known as Live Oak Bank will help you provide the financing to purchase these practices. And what's great about that is if you are set up in the right way and you have enough equity in your business, Live Oak Bank will actually write the entire check for the practice purchase. You then can buy the business and pay back the bank on a longer term, which that term is usually about 10 years. So what this does is this is significantly increasing your cash flow as you're buying that individual practice, that business. And it's also providing the seller the peace of mind that the check that they're getting for the practice is coming from a bank and not from your own personal checking account at the local bank. So The seller involvement in the deal is also extremely crucial. In our opinion, you want to see a seller involved in the transaction for a minimum, absolute minimum of 6 months, and ideally an 18-month transition period. And the reason that we feel that that's the case is because that will allow for 3 effective meetings or so between buyer, seller, and client. In our opinion, 3 meetings is what will really help to solidify the relationship for the buyer to continue that client moving forward. And if you feel like you're getting involved in a scenario where the seller is looking to retire in a 0 to 6 month time frame, you really want to make sure that the retention clause that you have in your contract is very strong, because you're putting yourself at risk as the buyer. So as we talked about, you have this down payment. We gave you a range, but in this overly competitive marketplace, sometimes we're seeing down payments go as high as 50 to 100%. And you always have to remember that cash is king. So if a seller is getting cash up front, they're going to feel more comfortable. Obviously, there's more risk to you as the buyer, but this is where the due diligence process comes in place as well. Prudent sellers are really not just going to let you take over. They know what their practice is worth. They know what they can get. They vetted it out to other potential buyers in many scenarios. And really what we want to just make sure of is that if this is a great practice for you, that you're willing to come up with the cash. And we found that utilizing organizations like a Live Oak Bank will really help to give you that competitive advantage. The next thing we want to think about is, does your broker-dealer potentially have a transition assistance program? There are many large firms and organizations out there that will help to finance both external and internal deals. And we've been involved in many of those situations where that's worked for everyone involved. Again, you have to remember that the seller is in the driver's seat. You as a buyer, to be successful, have to match what it is that they want to create within their own financial situation and really match that. So if a seller wants something that's going to be a 10-year deal, come up with what the best 10-year deal is. If they want more money up front, figure out a way to utilize your broker-dealer or Live Oak Bank or some of your own personal resources to get the deal done. As we mentioned, having that flexibility in the way that you structure deals is really going to help to put you towards the front of the list. So let's take a quick practice valuation example from a buyer's perspective on what you might pay for a particular practice. So this particular deal here that we did not too long ago was $25 million in assets under management with $300,000 in gross dealer concession. $200,000 of this practice was recurring revenue. $50,000 was transactional. Because this client and this particular seller had client base that was slightly older, recurring revenue was valued at 2 times recurring revenue, which 2 times 250 gave us $500,000. Now the traditional range you'll see is somewhere on recurring revenue 2 to 3 times, just dependent upon a number of key factors, which we'll address here in a moment. And then the transactional revenue in this seller situation was valued at 1 times recurring revenue. So 1 times 50,000 gave us 50,000. You add back the 500,000 value for the recurring, and we get a total practice value of 550,000. Again, this is representative only of a typical practice. Every deal is done different based on a number of different factors. We often provide valuations for sellers on a complimentary basis to really give you a good sense of what the practice would be worth and help to facilitate that process as well. Now, the way that this deal was structured was that it was 30% down, which was $165,000 of that 550, and it was a 5-year deal with a 5% note. And that was paid at $85,000 per year for a total practice value of $590,000. So some of the things you have to think about are the tax implications of this particular structure and how you set this up for yourself cash flow wise. The majority of the deals are set up in a way that it is considered capital gains to the seller. So it's cash and tax advantageous to the seller and disadvantageous to the buyer. So that's something to think about within your own cash flow needs. And as you're paying off these practices, you really want to take into account the tax implications that might affect your own personal cash flow. Next is the fine line between persistence and annoyance. So one of the things that we've seen is that time kills all deals, as I'm sure you've heard that adage before. But the other thing that will kill a deal is if you're too aggressive in your search or in your attempt to gather information. This is often mitigated by having the use of a third-party advisor like ourselves or some of the other firms out there that specialize in this business. And what it helps to do is act as that buffer. So one of the things you want to do is keep the deal moving forward, but you don't want to push too aggressively. The next thing you want to do is promptly respond to seller requests, questions, communications. You want to keep the deal moving forward. You meet with them one time, you have a phone conversation, maybe you take them out to lunch, you meet with their spouse or significant other. You really keep the process going so that you're solidifying the relationship with the seller and also really just keeping other potential suitors out. Always follow through with your promises and make sure that you do the due diligence on these practices to make sure that they are compatible and that you can buy it. Because you never want to take someone through a process and find out that you have to change the deal or change the terms at the very end. Obviously, that won't result in many successful outcomes. The next thing that we look at from the course of being a successful buyer is the deal flow. So we found that the ability to engage in multiple discussions will dramatically increase the chances of you closing on a particular practice. It's often very difficult to find sellers in this marketplace, as we talked about, with a 50-to-1 buyer to seller ratio. But the more deals you can put on the table, the better chances you have of closing a deal. And you have to remember as well, not every deal that you see is going to be the right fit for you. They might have proprietary products, they might have a non-compete. So you really want to make sure that if you are in fact intent on trying to buy a practice, that you have all the different avenues explored. You want to make sure that you're proactive in targeting multiple sellers and that really just going out and kicking all the tires and not leaving any stones unturned in your search. And we feel that if you can get in front of 4 to 6 deals in the course of a year, the chances of you closing on a practice are significantly increased. And many of the buyers that we've worked with who have been successful in that process have often closed successful deals. So what are some of the intangibles you should be thinking about in setting yourself up as a buyer? First thing that we see is really looking at your own profile, your own website, and your own financials. So the first thing is do you have a value proposition? Do you have something that explains what your practice is all about, that talks about you as a financial advisor, talks about your credentials and your team and your staff? Do you have a brochure? Also, do you have the ability or the bandwidth to take on another practice? So look at your own business financials and your own business setup, and are you set up in a way to take on another 100, 200, or 300 clients? And if the answer is yes, do you have a repeatable process and a staff that is competent enough to take on and do the paperwork for potentially another 500 to 1,000 accounts? And the other thing that you should have prepared as a buyer is really make sure that you know your own statistics. What are your product mixes? What are the different firms and companies that you work with? What is your AUM? What is your production? Are these things that you can easily spout out to someone who's asking you questions? How well do you know your own financials? And are you set up to really be successful in a buying process? Next thing that's becoming more and more important these days is, what does your website look like? We've seen many financial advisors not have websites, and as buyers, that puts you far beyond, or behind, I should say, where you should be as a buyer in comparison to other buyers out there. Make sure that you have something that's very helpful, that really explains, again, the process and what you are and who you are as a team and as a firm, and it has all the relative marketing pieces in there, because you better believe, as a seller in this internet era, that the sellers will be going onto your website and really understanding and looking at who you are before they even have a discussion with you. So think about what your website looks like, and there's many organizations and firms out there that will help to update those websites and increase them for a low cost, but really make it look a little bit more professional. Next thing is looking at the financials. As you embark on looking to buy practices, what's your own financial situation? Are you prepared to give your own financial documents and statements and net worth and cash flow of your own self to a seller, and as something that is strong enough to support the acquisition of a practice? Be prepared to document all of these different items as you look to third-party financing. So companies like Live Oak will require a number of different documents, not only about your own practice, but about you financially. Make sure that you have all of your ducks in a row to make sure that that process can be as smooth and as effective and efficient as possible. Other thing is, you be prepared to guarantee the financing, whether it be through liens on your properties or your assets, or through life insurance. These are all things that are requested on an everyday basis from sellers and banks to secure financing, so don't be surprised if that's asked for. The other thing is look at the broker-dealer. If you're part of a broker-dealer, do they have an assistance program? Many firms have very attractive programs out there for acquiring and recruiting practices in that will help to really offset some of the initial cost for you as a buyer. So first step I'd say is to talk to your broker-dealer if you are part of a broker-dealer and ask them those very important questions. Okay, so now that we've looked at some of the ways to solidify yourself as a buyer, let's transition and talk a little bit more about some of the transaction roadblocks and some of the barriers to entry and the barriers to closing on a particular practice and solidifying a deal. So the first one that we look at is unfortunately some of the most common is that we see a lot of sellers just kicking the tires, and ultimately they're not that ready to sell their practice when it's all said and done. They may just be fishing or curious to see what type of interest is in the marketplace. And sometimes they get cold feet because they realize they've been doing this for 20 or 30 or even 40 years and aren't really ready to retire. This is oftentimes an opportunity for you as a buyer to provide some of that flexibility. We talked earlier about the soft landing approach where an advisor might be 2 to 3 years away from retirement. Offering them a safe haven to come in and ultimately slow down in that particular scenario might encourage them to start to join your team and look at that flexibility as a great benefit to them. Because what we found in discussing these deals with sellers is that oftentimes they'll say that they're ready to retire in 3 to 5 years, and as we continue those discussions, those years will start to dwindle down. So if you can get a seller to commit to working with you, in many cases you'll see that you'll solidify that deal. It may not be in that 1 year time frame that you're hoping of, but if you can close that deal in 2 to 3 years, not only have you created great value for yourself and for the seller, but you've also solidified the relationships with the clients. And it also provides, again, a platform for the selling advisor to slow down and slowly transition their client base to you over time. Another transaction roadblock is really looking at how do we agree to terms. So you want to make sure that in the negotiation process, as well as the due diligence and as well as the initial letter of intent, that you really spell out the terms and that you're very upfront and honest with what the deal looks like. So the more full and fair disclosure you have, the better understanding the seller will have as really what is tangible and what's going to happen in this transaction. And in our opinion, the simpler you make the deal, the easier it is for the seller to understand it and the easier it is to get the deal done. So one of the things that we've seen is because the deal has been too complex or overwhelming to a seller, we've seen it really help to postpone the sale, confuse the seller, and ultimately give them a change of heart. So one of the things is you have to really be willing to help in this transition process and continue to have that flexibility. Another thing that happens in transaction is a lot of times a seller will consult with a third party that's not involved in this industry, and they might suggest that the practice is worth more money, or tell the seller to hold off and continue to grow their own business or create their business and turn it from a commission-based practice into a fee-based practice. As a buyer that the likelihood of someone who's been in the business for 30 years probably is not going to turn their entire client base around into a fee-based scenario, but sometimes when they get that thought in their mind, it'll often postpone the deal. And then also we want to look at the difference from a cash flow perspective from a seller's side, in that practice multiples of 2 times recurring revenue versus their current income. A lot of times we'll see sellers say, hey, well, listen, I'm just going to dwindle the business down. So these are some of the things that when an attorney might get involved, or another third party evaluation expert might spook the seller in some situations. In some cases, you have other things that are factors to hurting the deal as well. So client retention risk, the seller might not feel that they'll get that 70% or so of their clients over for a successful transaction. The credit risk, you as a buyer might not be financially capable enough to make the seller feel confident that you'll be able to pay for the practice. There's issues with compatibility from a firm, from a portability standpoint, whether it be products and services, U4 issues, compliance issues, whatever have you. Sometimes there's overkill for a seller who's gotten too many proposals. Oftentimes we'll see that in a marketplace scenario where they've gotten too many bids and it's just data overload. And then minor details, you might have a spouse's change of heart, or really just some things that come up personally for the sellers that would create them to want to delay the process. So when you're thinking about yourself as a buyer, The real question you should ask is, are you ready to get serious about acquiring a firm? And if you are, here are some things to really consider in being able to be highly effective and capable and really increasing that probability of success when it comes to completing an acquisition. So the first thing is you want to be proactive. As we've talked about throughout this presentation, really looking at your own practice and making sure it is set up to acquire a practice and assimilate a new client base, but also from a financial standpoint that allows you to be nimble enough to go out and buy practices and really contacting banks or your broker-dealer to determine what type of financing is available and if in fact you come across a deal. The next approach that we often recommend, as we've discussed earlier as well, is looking at multiple areas of attack, whether it be someone on your team or yourself making outbound calls, doing networking at local FPA meetings, working with firms like ourselves, putting yourself out there on some of these posting sites that have practices for sale. You want to make sure that you have a number of different areas that you're approaching, as well as working with your local wholesalers. Many times they're in touch with older financial advisors and they might refer you some business from time to time. So Advisor Successions, as we mentioned, is a firm that specializes in helping financial advisors buy and sell practices across the country. And through our exclusivity program, which is our geographical exclusivity program, we're able to eliminate a lot of the issues that we've addressed here in this presentation. First, we're able to take you as an advisor in a given territory and provide you full transaction support, meaning finding you practices, helping you to negotiate the deal, helping with all the different things that might come up from beginning to end, as well as helping to provide the paperwork and a smooth transition game plan. And what we're able to do is put you in front of a number of different practices throughout the course of a year. This way it really increases the number of at-bats that you have, as well as the likelihood that you'll be successful in closing a transaction. And we feel that by utilizing a firm like ours, we're able to really put you at the front of the line and really differentiate you as the buyer by giving you some consultative advice on how to structure your practice, but also how to obtain the financing that you would need necessary to buy multiple practices. So one of the things that we'd like to discuss with you, if in fact you're interested, is how this might work for you and if in fact your geographic territory is available. And some of the things that we'll do within that process is we'll do focused webinars to sellers. We do in-person seminars within your local community. We do have white papers. We do a number of different email and LinkedIn campaigns. We have a whole team and network of telemarketing professionals as well as other financial institutions that have provided opportunity and lead flow for you. And really what we want to do is practice what we preach and put you in front of all those different types of opportunities so that you have a multiple spoke approach that will allow you to increase your number of conversations that you have with potential sellers and really give you a better chance and a leg up in that scenario. So with that said, I want to thank you for taking the time today to listen to this presentation and this discussion. What I'll do now is pause for a few questions and we'll take it from there. Thank you again for your time.